Hi there and welcome. As a professor of taxation, I spend a lot of time on complex topics. But today, we're going to unpack one of the most important and, frankly, one of the most misunderstood parts of emigrating from Canada. We're talking about the departure tax. I'm Samira Alrashani, and I've put this guide together to try and make this topic as clear and straightforward as possible. So let's dive right in. So you're planning a move. It's exciting, right? A whole new chapter. But then this big question starts nagging at you. What about everything you've built here? Your stocks, maybe a business, all those investments you've carefully managed. How does Canada's tax system view your exit? Here's the game plan for our discussion. We'll start with the absolute basics. Then we'll get into when this tax is triggered, what assets are on the hook, and just as important, what assets are not. Finally, we'll cover the practical side of things, deferring the tax and filing the right paperwork. First things first. Before we get into the weeds, let's establish what we're actually talking about when we say departure tax. What is it really? And why does it even exist? This right here is the absolute heart of the matter. The whole system is built on a concept called deemed disposition. It's a bit of a legal fiction, but a powerful one. Basically, the moment you cease to be a Canadian resident for tax purposes, the Canada Revenue Agency, the CRA, deems you to have sold many of your assets for whatever they were worth on that day. It's a tax on the growth of your assets, even if you haven't actually sold a single thing. And this quote really hits the nail on the head. It perfectly explains the why. The government's logic is pretty straightforward. To prevent people from building up a lifetime of wealth in Canada and then moving to a low-tax country just before cashing in. The departure tax ensures that Canada gets to tax the value that was generated while you're a resident here. Okay, so that's the what and the why. Now, let's talk about the when. This tax isn't triggered just because you bought a one-way ticket. It all hinges on when you officially stop being a resident of Canada for tax purposes. So how is that date determined? Now, this is super important to understand. Your official departure date isn't necessarily the day you hop on the plane. The CRA looks for a clean break, so they consider the latest of these four events: the day you physically leave, the day your spouse or partner leaves, the day your kids or other dependents leave, and finally, the day you actually establish residency in your new home country. Let's clear up a huge misconception right now. The name departure tax is a bit misleading. It makes you picture paying a bill at the airport on your way out. That is absolutely not how it works. There's no CRA agent waiting for you at the gate. It's simply something you calculate and report on your final Canadian income tax return, which is due on the usual April 30th deadline. Okay, let's get into the really critical part. We know what this tax is and when it kicks in. The million-dollar question now is, what exactly are you taxed on? Which of your assets fall under this deemed disposition rule? This chart gives us a fantastic bird's-eye view. On the left, you see the property that's generally subject to the tax, and on the right, you'll see some really important exceptions. We're definitely going to talk about those exceptions, but first, let's drill down into what's included. As you can see, the net is cast pretty wide here. It covers all the usual suspects you'd find in an investment portfolio, but notice it also includes things like a business you might run outside of Canada, or even valuable personal items like art or a classic car. Now, figuring out the fair market value for a public stock is easy, but for private company shares or collectibles, that's where things get tricky and you really need proper valuations. Okay, let's make this concrete with an example. Imagine you bought Apple stock years ago for 20 grand, and now it's worth 100,000. On the day you leave Canada, even though you haven't touched your brokerage account, the CRA says, okay, for tax purposes, you just sold that stock. That creates an $80,000 capital gain that you have to report on your final tax return. All right, now for some good news. Not every single thing you own gets hit with this tax. The law carves out some very significant and very valuable exceptions. It's absolutely crucial you know what these are. And these are some big, big exceptions. For most people, the two most important are Canadian real estate and your registered retirement plans, like RRSPs. The logic here is that Canada knows it will get a chance to tax these later on, when you eventually sell the property or when you start withdrawing money from your RRSP. It makes sense, right? This example really drives the point home. Let's say your two biggest assets are your house and your RRSP. Well, guess what? Both of them are sheltered from the departure tax. There's no deemed sale, no tax bill to worry about on these major assets just because you're moving. That's a huge relief for a lot of people. So here's a classic dilemma. The government says you owe tax on a huge capital gain from your private company shares, but you don't have the cash to pay it because, well, you haven't actually sold anything. You're asset rich but cash poor. What do? And the answer, thankfully, is yes. You can make a formal choice, an election, to put off paying that tax until you actually sell the asset down the road. It's a critical safety valve, but, and you knew there'd be a but, it's not automatic. It comes with a condition. And here's the magic number you need to know. If the federal portion of your departure tax bill is more than this amount, the CRA will say, sure, you can defer, but you need to give us some security. It's basically their insurance policy to make sure they get paid eventually. And a quick note, this number is from 2016, so you should always check for the most current threshold. So what kind of security is the CRA looking for? Well, it's pretty logical. Often, you can just pledge the very shares that created the tax bill in the first place. If that's not possible, you can go to a bank and get a letter of credit or a guarantee. The CRA has standard agreements for all of this to make the process smoother. All right, we are on the home stretch. We've gone through all the theory. Now let's get down to brass tacks, the actual forms and the paperwork you'll need to handle when you file that final tax return. This table is your compliance cheat sheet. The first two forms are pretty much mandatory for anyone with significant assets. T2144 is that optional form we just talked about for deferring the tax. But I really want you to look at that last one, T2061. This is where things get really interesting from a planning perspective. It lets you choose to realize a loss on an excluded asset, say a rental property that's gone down in value, and use that loss to wipe out the gains on your other assets. It's a powerful tool. So, to bring it all together, here's your high-level action plan. 1. Pin down your official departure date. 2. Get proper valuations for all your property. 3. Complete that final tax return. And 4. File all the necessary forms and make those strategic elections. If you follow these steps, you'll be in great shape. And that's our look at Canada's departure tax. If there's one thing to take away from all this, it's that planning is everything. This isn't something to be afraid of, but it is something you absolutely have to prepare for. With the right information, it's a very manageable part of starting your next great adventure. Thanks so much for watching.